At the end of 2012, we were in a crisis. We were in several crises, but one of those crises was the tax law. What was going to happen with the tax law? The Bush tax rates are going to lapse. All kinds of bad things were going to happen. It was going to be Armageddon for personal taxpayers. And so what happened is, in addition to that, was the alternative minimum tax. That had a serious problem with it, and people were going to see their 2012 taxes go up, not just 2013. Lots of problems. What happened on January 1, Congress and the President agreed. They agreed on how the taxes were going to be modified so that we, the American people, could have some direction and know where we're going. So let's go ahead and look at what happens with the business tax. Business tax actually didn't turn out so bad. The first provision I want to talk about is depreciation. This is an area that businesses got a really terrific advantage on. Section 179 depreciation, the second item on the list, had been set to be $139,000 for 2012. That was all you could write off on assets you purchased in that year. And in 2013 and beyond, it was set to be $25,000. So businesses that were going to invest in new assets that had been customarily been able over the last several years to write off those assets using Section 179, we're going to see a serious curtailment in that deduction, and we're going to lose that ability to write that off immediately. They changed the law retroactive for 2012 and allowed us to write off $500,000 of assets that we purchased, the cost of those assets that we purchased in 2012 and 2013. So that businesses who might have invested in 2012 and maybe they invested more than $139,000, they can now get that $500,000 write-off. Businesses in 2013 can plan for asset acquisitions and know they're going to get an immediate tax deduction. Another great advantage for businesses. In addition to that, the first line item there says first-year bonus depreciation. Something new that came into the law 4 or 5 years ago was bonus depreciation, a concept we haven't had in the tax law. And that is that the cost of new equipment, so when the use starts with you, with your business, first use, so not new to you, but somebody else's equipment that you bought from them, brand new, you can write off 50% of the cost of that equipment in the year you acquire it. So we have these two things. We have first-year bonus depreciation for 2012 and 2013, 50%, and we have Section 179, $500,000 in 2012 and 2013. In addition to that, they allowed us to take Section 179 and off-the-shelf software, which we couldn't do, something a lot of people don't even know about, and they extended this rule for qualified real estate. What does that mean? That means that if we purchase, if we do improvements to our real estate as lessees, or even as lessors for lessees, we can write off $250,000 of those improvements in the year we do them. So that's half of the $500,000. So if you have $250,000 in equipment, $250,000 in leasehold improvements, you can write them all off. Contrast that with the rules for leasehold improvements are 39 years. So 39 years, just as an example, if you purchase $390,000 of depreciable of leasehold improvements under the old rules, $10,000 a year. Going to take you forever. Under these rules, $250,000 in the year of acquisition. In addition to that, we can get 15-year write-off on the rest of those qualified leasehold improvements. So that's just for 2012 and 2013. But a lot of people who can't write off their leasehold improvements otherwise and may not be making improvements to buildings have that ability to get that deduction immediately. So that's another terrific thing in the law that will really help businesses kind of pull us through some of the other things we're going to look at later, some of the tax increases. The other thing that they gave us was they gave us the luxury autos. Basically what happens is Congress a long time ago said, back in 1986, if you buy a vehicle and you depreciate that vehicle for business use, we will let you write off some of that, but we're going to severely limit what you can write off in any one year. And those severe limits, for example, let's say you bought a $50,000 car, you could write off $3,600 in the year you bought it. And then it went up a little bit in the year 2, and then down a little bit, and then like year 3 and 4, you're writing off $1,500 a year. You're never going to recover the cost of that car before it's trashed and gone. First year, $8,000 in addition to the $3,000, so you can write off $11,000. Now that's contrasted with if you get a sports utility vehicle with 6,000 pounds gross vehicle weight. That's beyond the discussion here. That has separate rules that we can talk about if anybody wants to ask me questions after here. There are a couple of other changes that I thought were worth us talking about. The first one is research and design. In prior years to 2012, Congress had always reinstated the research and design credit almost retroactively for the year. Almost at the end of the year they get to it and do it. The R&D credit is very important for a lot of businesses. I have several clients taking anywhere between $10,000 and $50,000 of tax credits, and a tax credit's different from a tax deduction. A tax deduction reduces your taxable income. A tax credit reduces the tax that you owe. So it's real dollars out of your pocket or in your pocket. So they have reinstated that for the next 2 years. They added a couple of other minor things in there, and we don't need to go into those, but those are there, those are in your information.